Hi there, welcome to Nepi Invest. So in today's video, I'm going to be looking at Telstra and whether it's time to buy. So when I'm referring time to buy, I'm referring to my own investing philosophy. So I have two different investing philosophies. So my first investing philosophy, which I do have a portfolio in, is I'm looking at growth companies that I can hold for the long term. And Telstra definitely does not fall within that category at all. And I'll just show you the numbers to confirm that. The second category or in philosophy I'm looking for is I'm looking for short-term holds based off sentiment and momentum. So technically I'm just looking for a company who have just transitioned into an uptrend, and then I'll just ride that uptrend as long as possible. So an example of that was Fortescue Metals, which I did own for a while, or any sort of company like Telstra, who I'm just going to own for, will never own for the long term. I'm just going to own for the short term because they can go through cycles with their share price, even if the company's financials don't change all that much. When I'm talking about don't change all that much, Telstra is the poster child for an example of that scenario. And just look at their financials here, and that will show that. So the first thing I do when I'm looking at a company is I look at their revenue, profit, and operating cash flow. And so I've just got here the 15-year history of Telstra going back to 2006. And you can see just on the revenue here, which is the top bar, there's no growth at all. So in fact, if you look at 2006 revenue, 22.7 billion. And in 2020, last financial year, revenue was 22.7 billion. So you could just take those 2 points in time and say Telstra has not grown at all. Very similar with net profit after tax and operating cash flow, no growth. In fact, if you look at those two metrics or those two values, it has actually gone backwards in the last few years. So I'm pretty sure net profit after tax and the operating cash flow have gone backwards in the last few years because of NBN and the margins Telstra will be getting from NBN, or clients switching to NBN, will be much less, and that might be a reason why the profit for Telstra has taken a bit of a hit. One of the good things about that is operating cash flow, even though it has gone back a little bit, hasn't gone backwards as much as net profit after tax. And if anything, I'm a much bigger fan of operating cash flow than net profit after tax. So the fact that it hasn't gone back as much as profit is a little bit of a tick in my books. So one of the things I'm in the process of developing now is a sort of a combined look at ratios, and I'm calling this ratio accumulation strength. It's one of the NEPI indicators. Actually, it's the first NEPI indicator. So what I'm doing is looking at four ratios I use: PE ratio, price to sales, price to book, and enterprise value over operating cash flow. Just see where a company is in relation to those ratios. So what I've done is I've just added those four ratios together, and based off the numbers of those four ratios, when you add them together, I get a number which is the ratio accumulation strength. And looking at those four ratios, for instance, if I look at PE ratio, if a company like Telstra is less than about 10 or so, that would be in my buy zone for just PE ratio. If it's above 18, 20, that would be in my sell zone, just looking at PE ratio. But I'm a firm believer you shouldn't be looking at one ratio, you should be looking at a number of different metrics. And so I've just used these four ratios and metrics, combined them together to come out with a raw ratio accumulation strength. So if a ratio accumulation strength, or RAS, is less than 22, this would be in a buy zone. And if it's greater than 34, it would be in a sell zone. So using that for Telstra, I come up with this table. Going back again to 2006, so looking at 15 years of data. And based off this, Telstra has been in the buy zone in two periods, and a very long period between 2009 and 11, where it was in buy zone for a long period of time. And then in 2018, also in a buy zone. Then it's been in the sell zone twice in 2015 and 19. And right now, currently, it's actually closer to a sell zone than a buy zone, which might surprise some people. I think the main reason behind that is the PE ratio is at 20.46, just because their profits have taken a big dive in the last few years. So we've seen the PE ratio really take off. But the EV to operating cash flow is actually right near my buy zone, around 8 or so. So looking at fairly good in the operating cash flow, even in price to sales and price to book, it's looking pretty good there. So it's only really PE ratio is looking bad there. So this is some way I like to look at it this way, and you can just see the trends here, how the price or the RAS has been going up and down, and this just shows you how sentiment changes. So with a company like Telstra, because the revenues and all those other financials haven't really changed all that much over 15 years, but rationally you'd probably suggest or think that because the revenue and all that jazz hasn't changed over the last 15 years, the share price shouldn't change all that much, but it does. The share price takes big shifts up and down over time, and that's just based off sentiment alone and momentum. And you actually see this with the ratio to accumulation strength. When the share price has been in these buy zones, or the ratio accumulation strength has been in the buy zones, that's when the share price has been at its lowest point, and that's when you would more likely or not want to buy. And then when the share price has been at its highest, that's when the ratio accumulation strength has been in its sell zone. That's when you more than likely don't want to buy, you want to sell at that point. And we can confirm that just by looking at the share price or the technicals. So what I've done here is just looking at a chart over the last 15 years. So this is a monthly chart, and I've just circled here where the RAS has been in the buy zone and when it's been in the sell zone. You can see when it's been in the buy zone, it's been at the low point of the share price history, and when it's been in the sell zone, especially in 2015, it's been at the high price in the share price history. So it corresponds fairly well to those peaks and troughs in the share price. So when I look at, the RAS is just looking at the financial indicators for buy or sell. So I also like to look at the technical analysis and see whether it's in a buy zone based off momentum and sentiment. So this is going back to 2009-11, looking at the weekly chart or monthly chart here. And we can see in 2009, 2010, still a lot of negative sentiment, share price still in a long-term downtrend. And you wouldn't want to buy them just because, if anything, the share price is going to go sideways. So not the time to buy 2009, 2010, even though the RAS was saying it was in a buy zone. But once we get to 2011, we can definitely see a bit of a shift in sentiment. So the main thing I'm looking at here is a change in the moving averages, especially the shorter term or medium term moving averages, which is the 20 and 50 week moving averages, which is the red and black line. And once that crosses over, you can see the black line crossing over the red zone or the red line. That would be right near the buy signal. And that's in June, July 2011 at around $2.70 to $2.80. And then over the next 3 or 4 years, the share price just took off. If you remember Telstra, we went from about $2.70 all the way up to over $6. So you would have made double your money in about 3 or 4 years, which is not that bad, but a good uptrend over 3 or 4 years. But once we get to 2015, if you looked at the RAS signal, there was definitely a sell signal in June 2015, and that's where I've circled it. And then that sell signal, based off the technicals alone, was later in the year, around September or so, where we saw the share price go below the moving averages, and we started to see the moving averages really start to go down. So the technical sell signal came a few months after the RAS sell signal. And then if we go a bit further in time to 2018, in fact, we had a RAS buy signal in 2018 and a RAS sell signal 1 year later, 2019. So this is just looking at a 2-year period. So in June 2018, based off the RAS, we can see that's right at the bottom of the share price chart. So it's almost exactly right at the bottom. And then we started to see the share price go up. So I think a lot of people saw some of those financial metrics, PE ratio, price to book, price to sales, even EV over operating cash flow, and went, based off the financials, this was a good time to buy. Based off the technical, we had a very small signal later in the year, about September or so, but the best buy signal was later in 2019, around January or February, where we definitely had a buy signal based off the moving averages going up, crossing each other, and then we just saw the share price run up over about 6 months or so. But we didn't have a very long uptrend here. So this uptrend was much shorter than the previous one between 2011 and 2015. And the corresponding sell signal in June 2019, corresponding to that circle there, was still in an uptrend. So in this sort of scenario, even though we had a RAS sell signal, I'd still maintain a holding in the company because we haven't seen a technical sell signal. In fact, the technical sell signal was a bit later on. The absolute sell signal was in February 2020. But you could have sold out around about September, October 2019 when the share price started to go sideways. In fact, that technical look is very similar to 2015 technical look, which is sort of a double top almost. So 2015 we had a double top, and this looks like very similar double topness. So is it time to buy Telstra? So what I've done here on the chart is just looked at the long-term downtrend from 2015. So you remember 2015 was what that first sell signal, and we've been in a long-term downtrend since then. So what I've done here, for those who don't know how to draw a long-term downtrend, is I've just taken the first two peaks in the share price in July 2015 and then July 2016, and just drawn a line that connected those two peaks all the way down. And we've hit that peak again in July 2019. So it seems like around July or the middle of the year, we always hit the peak. We then sort of went through that peak in January 2020, and then it failed. So it was a failed breakout in that number 4. And then we reached that again, the downtrend in July 2020. So it seems like July's every single year was when we reach the downtrend, and then we failed to go past it. And then right now we're right on the downtrend. So we've seen the last few weeks the share price of Telstra really take a bit of a ride upwards. So a combination of factors there. But anyway, I'm waiting for a confirmation and change in sentiment. So we're very close to getting a confirmation, but I need confirmation. So we're right on that downtrend. I need confirmation, change in sentiment, or a change in financials. So if they came out next week or a week after and saying they're expecting profits to go double in the next financial year, operating cash flow to go higher or something, I think that would be a sort of a signal of buy intent, and we'll probably see not only a financial buy signal, that will also lead to a technical buy signal as well. Now, I won't hope that they will stop the rot. So even though we've seen financials take a hit the last few years, I'm not going to hope they can change that rot because hope doesn't always lead. Hope is sort of the lazy way of holding a company. Just praying and hoping. It's not real investing. I think investing is you rely on reason and evidence, not on hope. So I won't hope that they can stop the rot, even though there is potential that they could be leaning on 5G to increase their profits over the next 5 years or so. I won't hope that is the case. And the other thing I'll be looking for is if they start to grow their financials again. So that's all I've got on Telstra for this episode. Hope you've enjoyed it. If you have any questions about Telstra, maybe you're a Telstra owner, maybe you think I'm wrong. I don't mind people disagreeing with what I believe, because one of the things I do, even if I don't buy Telstra, there's always going to be possibilities you can buy into other companies. So I look at the risk and reward scenario. And at this point in time, I still think there's a bit of risk with Telstra moving forward. So I'm not looking to buy, but I've definitely got it on my watch list. And if I do get some signals that it's time to buy, I will buy. But I won't be buying Telstra for the long term. It's only going to be for a short-term momentum trade, and I'll just ride it as long as possible. So that's all I've got for this video. Hope you've enjoyed it. And again, I'm not a financial advisor, so if you do need advice, make sure you seek out someone who is qualified. So that's all for today. See you later. Bye.